Charles McKinnon, CIO at Thurley Investment Managers, has joined us on the set. Charles, good to see you this morning.
Good to see you.
Thanks very much for coming up. Hugh, I interrupted you as you were getting into an explanation of why the Eurozone is going to be blown apart in 5 years' time by Ireland's move to backstop the Irish and the European banking system at the moment, it seems.
Well, quite, yeah. I mean, I think you actually just gave away my my punchline there, Jeff. I don't think I'd actually said that, but thank you very much for revealing it.
Well, I'm sorry.
And can you confirm that, given the negative trend in markets, that Sylvia now is dressing as a bear? Is that, I mean, she looks... Was that cool? No? Okay, so you can't confirm that. Okay, well, back to more serious matters.
Okay.
The decision, as I said, if left to stand by the Irish to ensure what is equivalent of 2 times its GDP, my prophecy to you is, if that's allowed to stand, it will bring down the euro. The euro is not a tenable currency if you have member states making such decisions. There's no such thing as a free lunch. Politicians have got to understand it. I tried to run this one past my wife last night, and she's a bit of a politician as well, I'm afraid. But the reality is, there's no free lunch, okay? And the decision led to the CDS swaps on Irish sovereign debt blowing out in the last 2 days. What does that mean? That is the cost. That is the market's best estimate, best hunch as to the probability of defaulting on debt, okay? And we have similar probabilities for corporations. We do it every day. And the reality now is the market believes that McDonald's, the burger chain, is of greater integrity, greater solvency, greater robustness than Ireland. And not just Ireland, but even the UK, Jeff. McDonald's has got less chance of going bust than the British government. Right? So when you see the politicians stand up with bailout plans, that's why I was aggrieved at the beginning, Jeff, because there's no such thing. We end up paying for it. How do we pay for it, Jeff? We pay for it because when our government comes to issue this sea of money, they're going to be paying through the nose. They're going to be paying junk bond yields if we can't constrain their behaviour. And that is paid out of our tax revenues.
You can sit in your ivory tower and throw stones at the politicians. The issue here is an orderly readjustment of an over-leveraged global economy. That's what we're looking at. And the consequences surely don't have to be that we throw millions of Americans out of their homes and millions of Europeans out of their homes as well. The solutions may not be perfect ones at this point, but they are an attempt at least to stabilise what effectively is a loss of confidence that using this mark-to-market model is forcing down the price of assets to unrealistic low levels.
You guys have just swallowed it, hook, line and sinker. We got into this mess because the business and the political elite believed they had abolished the business cycle. Right? The reality is we should have had a stinking recession at the turn of the century. We had malinvestment through all parts of the economy, principally through technology, media and telecoms. We burnt and destroyed lots of capital, and we should have suffered from it. But Greenspan and his acolytes said, we have abolished the business cycle. We will inflate the housing market. We'll make people feel mystically rich through the value of their house. And now, and of course in the last 12 months, the more credit they created, you discovered that you couldn't afford petrol, you discovered you couldn't afford food. This panacea was losing its mojo, and now we see the destruction as the asset values fall.
You are a creation of that easy money period, Hugh. The hedge fund industry emerged at a time when money was made cheap. Effectively, you know, the guys in the long industry that thought that there was another way of doing things came out of the long-only industry like grubs that turned into butterflies and then emerged to flap their wings and say, we know another way of doing this. But effectively, you know, this whole story about, well, we're full of portable alpha, which is in fact just beta to the market, was essentially about the liquidity that was chucked into the market by free money, and you're biting the hand that fed you guys.
Which is precisely why you should like the bailout plan. It's essentially a hedge fund. It's over-levered, it's slightly opaque, it buys all sorts of portions of the capital structure, and it basically has a few managers.
Come on, where are you? Come on, you guys. Which way? Did you call me grubby there?
No. Charles, let's bring you in here because you haven't had anything to say so far. Come on, join the conversation.
I'm not really in line with Hugh. I mean, I think that I agree entirely that the TARP is a hedge fund. I think that people who are placing a lot of reliance on the government to come and solve this problem, that's really hoping for the tooth fairy at this point, in my mind. Important to remember, 35% of all homes in America have no debt associated with them. So it's not everybody. That's 1 in 3 people. That's at least one of us round the table has no debt. Now, so there are people who've been damaged, but there's a lot of people who have not. I also think that a key component is that the seeds, I disagree with the seeds of this being sown in the turn of the century. The seeds were the dot-com collapse in 2000, 2003, many investors went and bought property because they thought this would be all right. And that's been the seed. There was easy money. It was easy. They bought real estate. I don't think that they were lulled into that. I don't think that you can blame politicians. I don't think you can blame banks. This is what they do. It's exactly, you talked about McDonald's. McDonald's being sued because people eat 10 Big Macs and then get fat. No, they don't have to do it. McDonald's is there to sell burgers. I think that saying banks shouldn't have lent money is immensely naive.
Hey. Now, listen, sometimes I speak quickly, sometimes I speak with a Scottish accent, sometimes, Jeff will tell you, I speak with a forked tongue, okay? But I said what you just said. I said that this problem emanated from the dot-com crash, which facilitated a willingness to lend into the property market, okay? Which then led to an elevated property market. I don't criticize.
Hugh, that is not what I said.
Lending.
I don't. What I said was people chose to borrow. I didn't say it facilitated.
People were encouraged to lend, right? Now, my point to you is, hey, listen, we always have lending. Capitalist system requires the resolve and the courage to take on loans to further your business, okay? What I contend is leverage ratios of 30 or 50 to 1. Now, Charles, you know that is Bank of America today. That is Barclays Bank today. That is HBOS today. We have seen in the last 10 years something unprecedented. It was never the case that your loans were never twice your deposits. Never until the last 10 years. And that was a massive gaming of the system to get return on equity, to get executive bonuses. And hedge funds were the only mavericks that said, this will end in disaster. That's why we've made money shorting the sector, and the long-only guys looked the other way.
Hugh, you stay with us. Charles, let's give you the final word here, and also maybe you can give us a steer on what investors ought to be doing in this response to Hugh.
When I was here a couple of months ago, I used the words that this is a normal crisis, and I have to say the last 2 weeks this has become a less normal crisis. I think that there's huge opportunity here for further damage. I think Hugh and I did agree before we were on air that I think that it's very important that you stick. Safety does matter. I think it's nuts to buy corporate bonds in fear of some implicit guarantee. I was reading the paper today saying corporate spreads are wide, they shouldn't be. No, we've always been government bond buyers. Why? Because the first point of a bond is you want to get your money back. That is the overriding USP of a bond, is you get your money back at some point in the future. Not buying a government bond, buying a corporate bond, you're taking a risk. So government bonds, also, again, agreeing with you here, there is going to be a flood of money issued both in the UK and in the US. So there is going to be an inflation problem at some point. And so given that you can still buy index-linked bonds, I would still be buying those.
Charles, thanks very much for coming in this morning. Great having you here. Charles McKinnon, CIO of Thurley Investment Managers. Hugh Hendry stays with us.